Due to the United States and Israel's recently coordinated airstrikes against Iran, it is important we discuss the top 4 reasons why the Strait of Hormuz is geographically the most crucial energy choke point in the Middle East. The implication of an extended or escalated war in the region could potentially close the Strait of Hormuz, leading to global economic disaster. And while we're sitting here in Western society dealing with our own economic deterioration, you can expect these 4 reasons to bring you both personal and financial stress if the conflict in the Middle East continues to escalate. Over 20% of all global oil passes through the Strait of Hormuz on a daily basis. This is 20 million barrels of oil per day. Additionally, at its most narrow point, it's only 21 miles wide, which allows it to be easily controlled if your military is in proper positioning. And if anything negative led to a temporary shutdown of the strait, the price of crude oil could jump nearly 80%, reaching its 120, 130 super macro supply level. And this is where point 2, the most crucial of the 4, comes in, because the 25-year yen carry trade relies on oil pricing stability. About 80% of Japan's total oil flows through the strait, making it a vital energy corridor for the country. Now let me connect the dots for you. Since 2001, Japan has injected 550 trillion yen into their economy via quantitative easing. This policy of increasing bond demand while lowering bond yields allows for cheap borrowing at low interest rates of your diluted currency. So institutions both globally and domestically can invest that borrowed cash into United States higher yielding assets like United States stocks and United States treasuries. The problem is the price of oil is denominated in United States dollars. So if crude goes from $60 a barrel to $130 a barrel, Japan cannot afford to pay twice as much for that. They're going to have to offload United States treasuries in order to strengthen their currency against the United States dollar, which would cause a massive deleveraging within the yen carry trade, forcing United States over-levered institutions to sell their United States equities and fixed income, causing a 10 to 15% correction in the stock market. Third up is inflation, because as you guys know, CPI, PPI, and PCE numbers have been stuck at that 3% level for the last year and a half. A spike in oil prices to $120, $130 a barrel will only make the energy sector worse. You're talking a 5% CPI print in the next 6 to 12 months, and we all know the stock market hates inflation because that means the central bank has to raise interest rates, constricting corporate earnings. And last but not least are our Asian countries and negative implications on their economies. While Ukraine may be the breadbasket of the world, 1/3 of all fertilizer flows through the Strait of Hormuz. Countries like Japan, China, and South Korea rely heavily on this route, not only for oil, but for food costs as well. And this would cause a direct hit to Asia's supply chain and markets. Despite decades of tensions, the Strait of Hormuz has never been formally shut down. But every push from the United States and Israel to force a regime change in Iran could have global economic implications.